Hello and welcome. I'm Jill Govind, a Tegeti consultant at Haines Solutions. This video introduces the first in a three-part series on IFRS 18, focused on the practical implications for finance teams. Throughout the series, we will examine how IFRS 18 reshapes the presentation of financial performance, clarifies the definition of operating profit, and influences reporting, close, and consolidation processes. At Haines Solutions, we support organizations in translating regulatory change into well-governed, sustainable reporting frameworks. Across this series, we will share practical insights to help you assess the impact of IFRS 18 and prepare your reporting processes with clarity and confidence. Financial reporting is evolving, and one of the most significant developments on the horizon is the introduction of a new standard. This standard has been issued by the ISAB with a clear objective: to improve the clarity, consistency, and the transparency of financial statements prepared under IFRS. In this short video, we'll explain in simple terms what IFRS 18 is, and importantly, who it applies to. IFRS 18 is a new international financial reporting standard that replaces the presentation requirements previously contained in IAS 1. Its purpose is straightforward: to make financial statements easier for investors and stakeholders to understand, and to make performance reporting more comparable from one company to the next. IFRS 18 changes how results are presented. It does not change how they are accounted for. So the underlying accounting rules remain the same. Revenue, expenses, assets, and liabilities will continue to be recognized and measured as they are today. What the standard introduces is a more structured way of organizing that information. From 2027 onwards, the statement of profit and loss must be presented using three clearly defined categories: operating, investing, and financing. This new format becomes mandatory, meaning companies will follow a consistent framework rather than designing their own layouts. IFRS 18 also introduces IFRS-defined subtotals, including operating profit, which becomes the primary measure of core business performance, and profit before financing and income tax. Because these subtotals are defined by IFRS, users of financial statements will be able to compare companies with much greater confidence and insight. So who needs to follow IFRS 18? The answer is simple: all organizations that prepare financial statements under IFRS. That includes publicly listed entities, large private groups, multinational businesses, and subsidiaries reporting into IFRS group accounts. Wherever IFRS is used, IFRS 18 will apply. Even companies that don't produce IFRS statutory accounts may still be impacted indirectly, particularly if they report into an IFRS parent or need to align their group reporting packs to the new structure. The standard becomes effective for annual periods beginning on or after the 1st of January 2027, and early adoption is permitted. However, IFRS 18 requires comparative information. That means the real work for finance teams must start well before 2027 to ensure that data is captured in the right way. IFRS 18 is more than just a new reporting format. It represents a meaningful step forward in IFRS performance reporting. By introducing clearer categories, defined subtotals, and more transparent disclosures, the standard aims to deliver financial statements that are easier to follow and easier to compare. For companies, this is not only a compliance requirement, but also a great opportunity to strengthen the way performance is communicated to the market. Thank you for watching, and please look out for our next video where we will explore how IFRS 18 will transform the profit and loss statement in more detail.